14 of this year. However, the index, if you look at it broadly, is still stuck in that 450 to 500 point range that it has found itself in the last 2-3 weeks. I mean, in this range bound trade, Nifty has found support at its 50-day moving average, which now sits at around 21,950 odd levels, but has at the same time has faced resistance around the 20-day moving average, currently placed at 2258 mark. Even today, if you look at Nifty, the index did manage to surpass the 20-day moving average, but given the last hour of selling, it could not sustain above it on a closing basis. So going forward, one perhaps should need to be slightly cautious and wait for a break on either side before taking aggressive bets. Sensex, on the other hand, surged about 500 points but could not close above the 73,000. And remember, Sensex has failed to close above the 73,000 for since March 14 as well. Also, I think there are a couple of reasons why one needs to be cautious. One, the large caps, they are clearly lacking a leadership role, and I mean, even if you look at the price action today, overall it's being dictated by a few select heavyweight stocks. Today, for example, 60% of all the gains for Nifty just came from two stocks, Reliance Industries and HDFC Bank. Yesterday, it was Reliance and HDFC Bank that were putting the markets down. So clearly, we are witnessing a churn, and until things clear up and there is clear leadership among large caps, I think one should be cautious before taking aggressive bets. I'll give you another reason. I mean, the overall breadth of the market, despite a 0.5% up move, is still favoring the bears. The advance to decline ratio currently is at around 1:1.3, which means one stock advance for every 1.3 stocks that fell. You can look at it as 3:4 ratio. But although considering that it's still favoring the bears, it's slightly better from yesterday's 1:1.6 advanced decline ratio, and a far cry from what we witnessed a couple of weeks back when one stock was rising for every 22 shares that were falling. That said, the broader markets, I mean, they are continuing on their path of recovery. The small cap index has recovered, almost 8% from its recent low. And the mid cap index has also done fairly well. It's up about 5.5% from their respective March low. So clearly we were witnessing a bit of a shakeout in the broader markets. Actually, let's call it what it was. It was a meltdown that was happening in the broader markets, but time and again we have seen that the broader markets, the participation will come back, and although this time around it was slower than it was in previous instances, the recovery is still happening. But that's enough from me. Let's bring on a real expert, Mr. Kranti Bhatini, equity strategist at Wealth Mill Securities. Kranti, thank you for joining us here on News, and what a day to have you, because I want to understand, what are you making of the markets at this point in time? Nifty clearly has edged higher, but it's lacking leadership as far as the large caps are concerned. The breadth of the market, it's still favoring the bears, but at the same time, we are seeing a tremendous recovery play out in the broader markets. What's your sense of things now, sir?
Yeah, so Yash, what we witnessed is a strong recovery in the market. Just remember a couple of weeks back, the despondency was in the market. People were thinking about 21,000 levels of the Nifty, whereas today we are back again about 22,000 levels. That's what a classic bull case scenario in Indian markets. What we can see is the sentiment has been improving, and crude oil prices have been quite stable. The macroeconomic data is quite robust in Indian markets. And we are heading into the earnings season. Going ahead, the earnings are going to drive the markets to sustain above these levels. By and large, what we can expect is during this phase in the next coming weeks, what we can expect is there's going to be by and large more about the stock specific action that's going to take place. As you rightly mentioned, two stocks from the large cap space, both the big boy Reliance Industries and HDFC Bank, they have been making the market to sustain because these stocks have not participated in the previous rally. So that's the liquidity is getting driven into these kind of stocks at this point of time. Given the kind of strong earning visibility also helps these companies to go up further. These stocks can sustain the market. But what we can expect going ahead is there's going to be a pure stock specific action that's going to play well in the coming weeks. But the macro environment data, that's where the change is coming at this point of time. The tax collection data has been quite robust, and both direct and indirect taxes have been quite robust. Current account deficit has been at a favorable level at this point of time. So all these macros are we can witness in stock markets right now.
All right, and certainly, the data that is coming out, at least as far as the macroeconomic data is concerned, it's clearly, indicating that India is still in that sweet spot, the Goldilocks situation, as we like to call it. And you also mentioned that, despite this recovery that we are seeing in the markets, it's still a stock specific, a sector specific, a theme specific sort of a market. And if you look at the returns, the top sectoral gainers today, one of them was Realty. I mean, this was on the back of this report that came out from Anirog, which shows that housing market, Kranti, continues to remain resilient in India. And I mean, according to this report, of course, the ongoing Jan to March quarter housing sales surged by about 14%, while average prices, they are up as much as 10 to 32%, and this is across 7 major cities in India. Meanwhile, this is a stark contrast to what's going on elsewhere. The housing market globally is in doldrums right now due to this high interest rate regime. And while the prices globally have held firm, builders are constructing fewer houses, indicating a lack of confidence. Kranti, coming to you, what explains this dichotomy? India's real estate sector doing phenomenally well, especially the housing sector, whereas everywhere else it's kind of frozen.
Yeah, Suyash, that's a classic example that shows the inherent strength of Indian economy, first of all. And second thing is, this time the builders have been quite correct in terms of the estimating the inventory. They are not demand and supply. And as you rightly mentioned, despite of the high interest rate regime we went through, we have not witnessed any kind of slowdown in the realty place in India. And in fact, in 2023, for the calendar year, reality index was the one of the largest gainer in the sectoral indices. So still the momentum is on. It shows the inherent strength of the economy, and people are taking the credit to buy the homes. It shows the confidence of the people, and the future prospects of the economy going ahead. And it's not only reality, Suyash. When one consumer or the house buyer buys one property, it helps the other allied sectors like steel, cement, and other interiors and different pipes, infrastructure. Many
Right.
companies will be indirectly get benefited. That effect we are going to witness in the coming quarters.
All right, and of course, the realty sector is helping prop up a lot of these sectors that you have put forth, your metals, your pipes, your infrastructure focused sectors. But, Kranti, considering that the trend, this increase that we are seeing in house sales as well as the prices continues, considering that RBI, most of us expect them to start easing rates down the road, probably, starting in the latter half of this calendar year itself. So pretty much the financing of homes will become easier. I mean, is there still money to be made in realty stocks? Because they have corrected over the course of the last month, although some of these stocks, they have recovered almost pretty much of what was lost. Considering that this theme is not just, a sectoral theme that plays out over the next 6 months, it is, a multi-decadal sort of a theme. Do you still see realty sectors outperforming the markets at large?
So, Yash, one thing is, a year back, when we see the reality stock valuation with respect to the global peers like the real estate companies in Hong Kong and other parts of the world, the Indian stocks are available at a quite cheaper rate. So that valuation play has played very well in Indian markets, and what we witnessed is the reality stocks outperforming. If you ask me, Kranti, this the same kind of momentum is going to continue. Probably at this point of time, by and large, it's going to be more about it's going to be by and large stock specific, and where the builder is going to operate, which particular pockets. So these are the place right now it's going to play. And what I can see is these stocks are fully priced in at this point of time. So it's going to be by and large stock specific going ahead rather than taking the entire reality space into the bucket.
All right, and considering that you just also mentioned that where they are building and where they are coming out with these projects, because the tier 1 cities, I mean, of course, we are seeing a significant surge in prices as well as volumes. The market pretty much seems rather saturated as far as the affordable housing goes, but tier 2, tier 3 cities, I mean, they are just getting on the map. More and more projects are propping up. So should one look at stocks and companies that are focused in these tier 2, tier 3 cities, in your opinion?
Definitely, definitely one can consider, but here the question is what valuation one is accumulating these stocks. That is extremely crucial. So that's the reason we need to look into the stock specific action in reality space. But still, there is a still some kind of headroom is left in reality stocks, but not like the outperformance. But still, one can make money in reality space going ahead also, Suyash.
All right, and before we let you go, sir, BSE has finally put forth a list of 25 stocks that will be eligible for the T+2, T+0 or below prices, the prevalent price in the T+1 cycle. This band, by the way, will be recalibrated after every 50 basis point movement in the underlying T+1 market. But one needs to remember that all the charges or fees that are applicable, the transaction charges, SCT, regulatory fees and all that are applicable on the T+1 cycle will also be applicable in the T+0 cycle as well. And Kranti, coming to you, I mean, a shorter settlement cycle will definitely, enable faster fund remittances for investors, improve cash flow, liquidity, improve liquidity in the markets as well. But, a certain pocket of the market is still concerned about, the implementation of this T+0 cycle. Remember, we have just moved into the T+1 settlement cycle just a year ago, but there are concerns about if the current infrastructure can support this. Also it could create a liquidity fragmentation in the markets. Which side of the table are you on? Do you think, broadly speaking, this will benefit our markets?
Yeah, definitely, Suyash. Just want to emphasize investors. We came long way from T+15 settlement and T+2. We were there for quite a long time, and we are back at 2+1, and now we are talking about T+0. We need to allow the exchanges to the system, the market infrastructure to settle down. It's a welcoming move. Slowly in phases, we are going to get into the so much dynamics of T+0, which is a welcoming move, but it doesn't mean that investors should not get in a wrong corner. Stock markets are not a ATM machines where you can buy and try to get the money. It's not the notion. Okay, the market infrastructure is becoming dynamic. They want to facilitate the trades on a real-time basis over a period of time. It's a very welcoming move, the T+0. We need to see how the things are going to evaluate. People expressed their concerns when the regulators started T+1 settlement. Now T+1 settlement past 1 year have been doing very good. We are it is in a auto mode right now. So going ahead, there will be T+0. Many stocks will be added, and the market infrastructure is going to be developed over a period of time. So we are in the initial phases. We need to wait and watch how things, the smoothness will be. Definitely, right now, given the kind of technology we are in, it's a very welcoming move for the investors, but they should not treat, it should not be like a ATM machine.
All right, it's a welcoming move, but remember the T+0 settlement, at least in the phase 1, will only be applicable for 25 stocks, and only trades that are settled within the time of 9:15 a.m. when the market opens to 1:30 p.m. will be eligible for this T+0 settlement. The idea, of course, is to move towards instantaneous settlement by 2025. But Kranti, always great insights from you. Thank you for your time and your words of wisdom, sir.
Thank you, Suyash. Always my pleasure.
With that, it's a wrap on this edition of Last Tick. We'll see you tomorrow at 9:45 with First Tick. But up next is Business Plus.
Start with the end in mind. You need to know where you want to reach. Every morning that we wake up, we are exercising our choice. The destiny is decided. The results are known that I'm going to win. life of a goalkeeper is something which is always interesting.